Welcome to another video of Investing RX. So in our first inaugural video, we went over some of the basic steps in practicing good financial management. And it started with the fundamentals. This is a site I went over. Step 0, creating a budget. Step 1, building an emergency fund, paying off debt, and investing. And in fact, most of these steps were opening up and putting money into weirdly named accounts like 401k and IRA. And you might be wondering why we emphasize putting money in these accounts besides sounding sophisticated. I got a large 401k. It's beyond that. These are tax advantage accounts, meaning you get a tax benefit. You should always know what you're putting your money into. So this video is going to take a closer look into these accounts and really hopefully make you understand them and why it's sound financial advice to invest in these first. But before we start, let's just talk about taxes. Now, the tax code is incredibly dense and it's incredibly complicated, but really you only need to know the basics first. When you make money and invest, you get taxed 3 ways. You get income tax. That's the basic tax that you get from your paycheck. And I really like this site. It tells you, it kind of breaks down how much you're taxed, and how much you're taxed depends on where you live. So let's say you graduated and you match into emergency medicine in Kentucky. Shout out to Gage. You get your first resident contract and it says you make $56,000 a year. So I'll just plug that in, and you make it in Kentucky and you're single, and it shows you your total income tax, federal, FICA, state, local, and then it shows you your take home pay. This is a great tool for when you do get your resident contract and you want to see how much you are going to make in the future and plan that out accordingly so you can set up your budget. So that is your income tax. And let's say you get your monthly paycheck and you want to start investing some of it. You open up an online account so you can buy things like stocks and you can buy things like bonds. And so you buy some stocks and you buy some bonds and you're feeling pretty good about yourself. Let's say that your bonds pay a 2% interest. That means they pay 2% every year. Well, you get taxed on that interest. Uncle Sam will see that you're making some money and say, I want a cut of that. And you will get taxed on that interest. Well, how about stocks? Do they get taxed? Well, yes, they do. You know that when stock prices go up, the stock value increases. But did you know that some stock companies, they'll take their earnings and give a little bit back to you, the lovely shareholders? For example, if you buy 1 share of Microsoft stock, every quarter, basically every few months, you'll get 51 cents. And that's not a lot of money, but it does add up over time, especially if you have a lot of shares. And Uncle Sam will say, you're making some money. I want a cut of that. And so you will get taxed on those. Those are called dividends. So you'll get taxed on dividends and on your interest. Now let's move on to the last portion. Let's say over the decades, you've continued to buy more and more stocks and bonds, and now you're ready to retire. Some of those stocks have gone way up in value and price. Good for you. And you want to sell some of it. That's called capital gains. Capital gains means a profit from selling an investment or property. And when you make a profit, Uncle Sam will see that and say, I want to share of that. I want a cut of that. And that is called tax on capital gains. So essentially, whenever you make money, Uncle Sam will want a cut of it. That's being taxed 3 ways. And in another video, I'll talk about rates and tax code and all that stuff. But this is the basics. And you're looking at this and you say, well, that kind of sucks. Can I invest in a way that reduces this taxation legally and in a way that is incentivized by the government? And that's where we get into our tax advantage accounts, our 401k, our IRA, our HSA, all the abbreviations. So let's start with the 401k first. Let's start with the basics of a 401k. You start your job, and a lot of employers will offer you a retirement plan. And they want you to contribute to this retirement plan. They want you to contribute to funding your retirement. So they incentivize it. A lot of them will match a portion of whatever you contribute. I talked about how my employer matches up to 3% of my salary. So if I made 100K, which I don't, but if I did, and I contribute $3,000, then they will match that and give me $3,000. That's free money. That's an incredible benefit. Now, benefit to number 2, you contribute pre-income tax money. So you skip this step. You skip this level of taxation. That means your money goes directly from your paycheck to this account. That's a huge difference. You're not paying 25% in taxes. You're not losing 25% of it before it even goes to your 401k. Now, benefit number 3, it grows tax-free. Those dividends and interest that you earn in that account will not get taxed over the years until you eventually choose to withdraw withdraw it. So essentially, we're crossing off some of the ways that the government taxes you. And because of this, they want to put a limit on how much you can put in a 401k. They can't afford to lose too much money. And that is going to be $19,500 a year. That's a lot of money. Most residents can't meet that. I don't propose that you do. What I do propose is that you at least contribute as much as your employer will match, because that's free money that you don't want to leave on the table. Now, some other limitations is because this is a retirement account, they don't want you to withdraw early, so you have to wait until you're 59 and a half years old to withdraw it. And when you withdraw it, then it gets taxed, but again, you've already reaped the benefits of not having income tax on it, and basically years and even decades of not paying tax on your dividends and interest until basically the end. If you do need it earlier, you can withdraw earlier, but you do get a 10% penalty on it. All right, that is your 401k. That's your employer retirement plan. But let's say you have that employer retirement plan, but you want to also want to start one of your own, something that you have a little bit more freedom and control over. You want to start an individual retirement account. That's called an IRA. And the benefits of it is huge. You have to pay income tax, but that's it. Anything you put in is not subject to these other forms of taxation. So you don't pay taxes on dividends and interest ever. You don't pay taxes on capital gains when you sell and withdraw your money. So it grows and grows, and you can withdraw it tax free. That's an incredible benefit. Because it's an incredible tax benefit, they're going to put contribution limits on it, and the contribution limit is $6,000 a year, which I think is doable. It's about $500 a month. Now, there are other limitations because it's a retirement account. They don't want you to withdraw early, so you have to wait until you're 59 and a half or face a penalty. And there are some other circumstances where you can withdraw it, like if you're buying a new home or if you become disabled. I'll put a link in below and you can read a little bit more of the granular details. But IRA is an incredible investment tool. Now, last but not least is an HSA. So you have accounts for retirement. This is an account for healthcare expenses. The thought of which is when you're older, then healthcare expenses can rack up and really eat into your basically your retirement. They don't want that, so they want to incentivize Americans to open these accounts, to save, and therefore be prepared for healthcare expenditures. And because they want to incentivize Americans, it is triple tax advantage. What the heck does that mean? That means these 3 ways that you get taxed do not apply. None of it applies. That's incredible. So income tax does not apply. If you open an HSA with your employer, the money goes directly from your paycheck to the HSA, right? It doesn't get taxed. It doesn't face this 25% total income tax. If you open one up without your employer, if you open one up individually and you contribute to it, then you can write that off when you do your taxes. You don't get taxed on dividends and interest in it. It can grow and grow and grow tax free. And when you do decide to sell some of your investments and withdraw some of the money, it does not get taxed for capital gains. So it's triple tax advantage. Because of that, they put a cap on it, and the cap is $35.50 a year. Divided monthly is not too bad. Some other limitations, they want you to use it for medical expenses. Because of the tax benefits, they don't want people to abuse this account. So if you use it for non-medical related expenses, then you are going to be taxed, and you are going to pay a hefty penalty. There's a disclaimer. This is not true. It's not true that it's triple tax advantage in all states. California and New Jersey are exceptions, just an FYI, but those are essentially your tax advantage accounts explained. Remember your steps? Let's go back to our steps. You want to budget, you want to create an emergency fund, pay off debts, and all that good stuff. And once that is done, you want to max these out every year. You want to max out your IRA, your HSA, and contribute to whatever your 401k matches. And that's a pretty lofty goal, but if you can do it, then you set yourself up in great shape moving forward. And you might be wondering, okay, I've opened up my accounts, funded them, but what should I actually invest in? If you give tax benefits, should I invest in things that you talked about, like bonds that pay high interest or stocks that pay high dividends? Because I know they will get sheltered from tax, and you're absolutely right in thinking that. That's exactly what you should do. So here's a website, link will be in the description, of all the things and assets that you can buy, like stocks and bonds and REITs, and how tax efficient or tax inefficient they are. And things that are tax inefficient, you should put in your HSA, your IRA, your 401k. If you want to buy REITs, then that should go into your 401k or your IRA. They should not go into anything else because they're tax inefficient. And you might be saying, what the heck are REITs? Please stop saying the word REITs. A REIT is basically a company that invests into real estate. Now, some REITs invest in the nursing homes, some invest in the malls. It allows you to invest in the real estate without the hassle, and they're notorious for high payouts. They're required by law to pay at like 90% of their income to their shareholders. So you get paid, and because you know you're going to get paid, you're going to get taxed. And that makes them very tax inefficient. So there's a big REIT called Realty Income Corp. I mean, even on their front page, they're advertising how much they pay out in dividends. So these definitely you would want to put into tax advantage accounts. So if you look at mine, my IRA is actually entirely made up of REITs. And once you fill your tax advantage accounts with these funds like REITs and bonds, and then the rest of it, the tax efficient things can be placed anywhere. I have placed stocks and funds into my 401k and my HSA. So take a look at this website. It is fantastic. That's a quick rundown on tax advantage accounts and what you should hold in them. Hope you liked this video. Hope you found it informative. Leave a comment and let me know other topics you want me to go over. If you like this video, give it a like, subscribe for more videos of this series. Thanks for watching. Bye.